Hi guys, welcome back to the channel, the Daily Forex. In today's video, I'm going to share with you guys, one of the best strategy that you can use to grow a small account and catch spikes on crash and boom. All right. Now on the crash market, we're going to be catching spikes, which means we're going to be selling, while on the boom market, we're going to be buying to catch our spikes. All right. So this is a spike caching strategy and also a strategy that you can use to grow your small account by cashing the spikes. All right, so it's all cashing spike with this strategy. Okay, now this strategy is about 98% accuracy. Now the reason I call this strategy 98% accuracy is because there's no strategy that is 100% really that accurate, right? But you can see that with this strategy you can use it to grow your small account very perfectly with 98%. Okay, I'm going to share with you guys what I mean by that. All right, now first and foremost, let's start up with the parameters for the strategy. Now go over to the indicator section right here, and we'll put for the indicator window 1, you want to put the MACD to fast EMA 12, slow EMA 26, MACD SMA 9, then you apply to close. The style you put that to color black, color the on 3 pixels for the mains, then the signal you put 3 pixels color red with this first red line, then you click on done after that. Then second indicator you want to put on the moving average on period 1, shift 0, method exponential, then you apply to first indicator data. All right, then you don't add any levels. For the style you put that to 3 pixels color the color blue, as you can see, then with this first red line, then you click on save. Then the third indicator, relative strength index, all right, period 1, then you apply to close, levels 10, 90, as you can see at the very point. Then for the style you put that to 4 pixel color black, then you click on save. Then the style right here, you want to put that to 1 pixel color white with this first red line, then you click on save as well. All right, as you can see at the very point. Now as you can see, we have 2 levels here. We have the level of 90 at the very point, we have the level of 10 at the very point. Okay, now here signifies the overbought, signifies the oversold position. Now when you're taking this strategy, you want to be extremely careful when doing your analysis. All right, because this market is really risky. Now as you can see right here, let's go towards the current market trend right now. All right, as you can see, spikes just happened in the market, and when you're doing this, you make sure you're using the third zoom levels. All right, the third zoom levels. Okay, now what we can see here is that when this moving average at MACD at the very point got to this point right here, which is the level of 90 overbought, the market tends to spike. You can see there was a spike at the very point, so you only aim for position whereby it's likely for the MACD and the moving average together meet at the overbought region, which is the level of 90 at this very point. So when both indicators meet here, then you can see the spike will happen, another one happen here again, another spike would happen. As you can see, it just happened again, another spike. All right, now whenever the moving average and the MACD gets to the level of 90, when spike happened at this very point, the market tends to sell towards the downward trend. At that period whereby the market is selling towards the downward trend, another spike tends to happen as well. Okay, so we see one spike here happened here when it got to the level of 90 at the very point. Another spike happened again after it bought a little bit, then it dropped downwards, just as you can see right now. Now how do you tell if continuous spikes is going to be on the market? What you do is go over to the higher time frame, like the 1 hour time frame. As you can see at the very point, I am currently on the 1 hour time frame right now. All right, so we're looking for possible you can see this chart already is telling us that this market is already at the oversold, but it's going to buy, right? So but based on we are using the 1 minute time frame to scalp cash spike, we can't follow the 1 hour time frame to place our entry, but we only use it to observe, right? That's why we are on the 1 hour time frame. We observe the chart. Okay, now what I'm seeing right here is that the market should buy, but it should sell again, but it's going to buy for a certain amount of time before it's going to drop. So what you're going to be expecting right now is on the 1 minute time frame is that the market is going to buy a little bit. Okay, the market is going to buy, but it's still going to sell. So what we do right here is to observe when the market buys up to this point before you place your sell, again, you can see the market should buy, as you can see right now. So the market should buy for a certain amount of time. If it goes to this level 90 again, then it should sell. Now there are instances whereby the market will need to buy for a certain amount of time before it drops. You can see the same scenario that I told you earlier, that once price gets here, it tends to sell again for another sell. Okay, so it determines how high the level of the overbought is before another spike would drop again. Right, now how do you take this strategy perfectly? The way you can take this strategy perfectly is by only waiting for these opportunities whereby the MACD and the moving average gets to the level of 90. All right, that is when you wait for that perfect opportunity. So those are the perfect points and opportunity that you should observe and wait for, and also go over to the higher time frame, confirm those entries, then you place your sell and you're good to go. Okay, very good and easy strategy, okay, for you to understand when you're trading the crash market. All right, now let's go over to boom 1000 right now, using the same parameters. Okay, using the same parameters on the boom market. Now, as you can see right here, we are currently on boom 1000. Remember, we're using the third zoom levels. Okay, the third zoom level. All right, now on the boom market right here, what you observe is once the price, which is once the MACD and the moving average together, once they get to this point here, level of 10, the market should buy for a certain amount of time. As you can see, once they get here, the market will continuously buy. Now, remember I said on the crash market, it depends on how high that point, which is the level of 90, is. Okay, it depends on how high. Now, how do you measure the height of at that point? Is that you look how long the market bought. Okay, if the buys is a very long buy, okay, so the market will tend to sell for that same length which the market bought. The market will tend to sell, although it's not going to be exactly that same length, but it's still going to sell for that. Let's say if the market bought here, you can see the market from here now. All right, this is a perfect example. The market bought from here up to this point here. As you can see, let's all right, now the market bought up to this point, as you can see, and also you can see that the market from this point now, it sold almost at the same position as this buy. Market bought up to this point, then it sold to this buy. So this is what I'm trying to explain to you guys, that when the market buy to a certain amount of height, it tends to sell from with that same length that it bought. Right, now what I'm saying here is that you can see that the market also, from here it sold up to this point, so bought again. It's not going to be exact the same, but it's going to be almost at that same point. I hope you are getting what I'm saying to you guys. All right, now this is how you observe and do your analysis. Okay, although if you are going for that short term buys, you don't want to wait again for another spike to happen. You can just take that first spike that comes into the market. All right, into the market. Now you observe when the MACD and the moving average gets to this point, level of 10, you only, on a crash market, you look at the overbought, which is the 90 level. On the boom, you look at the oversold, which is the 10 level. Okay, so you're only going for those spikes alone. You're only going for those spikes, right? And why it is best in catching the spikes is because it's a lot easier to catch spikes than trading the candles. Okay, it's less risky when you're catching the spikes than when you're trading the candles. I know some of you will not understand this, what I'm saying, but if you consistently trade boom and crash, you know that it is it is less risky when you're catching the spikes than when you're trading the candles, because when you're catching the spikes, you can actually use stop loss, right? But when you're trading the candles, you don't use stop loss. Okay, so the only stop loss you can use is manual stop loss, whereby you exit out of the market on your own. So you cannot set a stop loss. Okay, that all right, if this market buys, or if the market sold when I'm trying to buy, right? I will set stop loss, and let's say, okay, if the market buys for a certain amount of time, then I should set stop loss around this region, so that once it buys above the stop loss, my trade will automatically close. It doesn't work like that. Okay, the stop loss doesn't work. So if you're buying the market on crash and the sell comes in, if you break your stop loss and you still end up in a losing trade, it won't defend you. Okay, so what I'm trying to say here is that it's a lot less risky when you're catching a spike, because you already know how much you are really willing to risk. If it's you want to risk about 5 to 10 candlesticks on the market, you can risk those 10 or 5 candlesticks, knowing that okay, this is what I want to risk when I'm trying to cash the spikes. I hope you understand what I've said to you guys. Now remember, on the crash market, you go for that 90 level. When price gets to that 90 level, it tends to sell. All right, and to sell again, depending on the how high the market buys. All right, then once it gets to the oversold level on boom, it should buy. Once it gets to this level of 10 here, you'll see that if you buy from that point in time, here again, level of 10 at this very point, the market bought. You can see there was a very long spike at that very point. From here, go to the level of 10, you can see it spiked. It sold again, it spiked, you can see. All right, so I hope you understand everything that I've said to you guys on this boom and crash spike cashing strategy of 98 percent accuracy. All right, so guys, if you found value in this video, do it to like and subscribe to this channel, the Daily Forex, and also guys, join my Telegram community, the Daily Forex on Telegram. On my Telegram community, I show you guys, free signals, tips, and strategies, and also have a VIP section whereby I give you guys up to 10 signals daily on boom and crash, and also Forex, another, volatility index as well. All right, so do it to like and subscribe. I'll see you guys on the next video.